Good morning and welcome. You're watching the Small and Mid-Cap Show on NDTV Profit. I'm Hersh Sayta. Quick check on where we are, where markets are concerned. We're up around 0.75% in trade above the 22,000 mark. Slight slip up in the middle of that graph that you see, where we slipped briefly below the 22K mark, but we're holding up firm and strong above the 22,000 right off the bat. You're 150 points in the positive where the Nifty is concerned. In terms of the contributories, I'm going to quickly try and load that. You have the likes of an HDFC Bank leading the rally today in terms of points. A third of all positive points contributed by HDFC Bank alone, 50 points there on HDFC Bank. You also have the likes of an Infi and RIL and Wipro contributing significantly to the Nifty 50 benchmark. In terms of the losers, you have the likes of a Bajaj Finance and HDFC Life, which are trailing in terms of, or rather putting some bit of pressure in terms of the negative contributories. Where some of the sectoral indices are concerned, let me quickly first pull up the Nifty IT chart as well as the Nifty IT index. It's up firmly in trade, 1.8 odd percent on the Nifty IT. Tapering off after those initial gains, but let's also pull up the constituents just to see how the Nifty IT has rallied. It was up 5% in trade on Friday, continues to go higher as we speak. HCL Tech, after a stellar set, up around 2.6 odd percent. Wipro, of course, no explanations there, up 6.8% on the back of good earnings. So the IT pack continues to lead the rally, but outside of that, you can see participation coming in from both HDFC as well as Reliance today. That's been the theme. Also, I want to pull up the likes of a Nifty Media and Metal, because those two are the ones trailing in trade today, nearly 1% down on the Nifty Media, almost 0.2% down on the Nifty Metal index. So both of those are the key laggards in terms of sectoral indices. Among others, you are also seeing good traction on the Nifty Bank, which is up around 0.6%. So across the board, you're seeing good positivity. Also, if I could quickly flag off the advanced decline ratio, that is currently largely 1:1. You're seeing a slight bit of favor in terms of the advances, and the small and mid-cap indices also doing decently well in the green, at least as we speak, but underperforming the benchmark, both of those indices. But, as we always do every day, we'll focus on certain small and mid-cap names, and we have today Patanjali Foods with us, the management. And the stock is trading with cuts today, but has gained around 1.5% in the last 5 sessions. It's been over 4% higher over the last month or so. We have Sanjeev Asthana, who's the CEO of Patanjali Foods, joining us to discuss about how the company is doing, what can we expect going forward, and what's the business outlook really like. Welcome on board. Welcome to NDTV Profit, Mr. Asthana.
Thank you.
So, sir, talk to us. It's been a couple of quarters since, the fundraise has happened. The promoter holding is now firmly below 75. What next? What do we look at in terms of the next trigger where Patanjali is concerned? Where does revenue grow or go to in the next 3 to 5 years, and where does EBITDA margin as well as EBITDA go to from the current level?
No, so in terms of any major fundraise, we don't require, because our balance sheet is pretty strong. We've got enough and more cash sitting in the books. We have a good free cash flow situation. Our requirements of capital expenditure are minimal right now. So we just have about, base level capex that we do, which is just, the north of about between 100 to 150 crores typically that we require. So in terms of the accrual of cash in the balance sheet, in terms of the growth momentum the company has, there is nothing which is major, which is on the cards. I think the work which we have cut out for ourselves is that, balance out our margin construct. So the effort which was going on in terms of, expanding the FMCG portfolio, that has continued to grow very well. We are growing at about 15 to 17% year on year, quarter on quarter. So that's been a very good growth momentum we've had. FMCG margin, typically, we have kept it in a range bound, between 16 and 18%. The edible oil, was a bit of a disappointment for last several quarters owing to global factors, which did not allow the domestic producers to sort of pass on the brand premium to the consumers because of the heavy pressure on the pricing. But in the last quarter onwards, we are seeing a stability in that. So hopefully, I think we will get on to the better ways in the way the market is going to sort of get built up. Our focus is very clear that we'll grow our FMCG portfolio. We want to stabilize our edible oil margins. Our oil palm plantation progress is very decent in terms of both the infrastructure that we're putting on ground as well as the fresh plantation that we are putting every quarter on quarter. So overall, our target is that we'll continue to grow, on the way we have projected earlier. And one more part I wanted to add, this effort towards the premiumization that continues to happen. We are doing a lot of work on the advertisements and promotion. As you know that we'd sort of taken on board Mr. M.S. Dhoni for our Mahakosh and Sunrich oils. We have launched an aggressive campaign on Nutrela, both on social media and beyond that. We're running a fresh campaign on Chyawanprash and honey. So net, it is a 101 of, a classical sort of work is cut out for us to basically grow the business in a very structured way, stabilize the margin and, move towards a double-digit EBITDA over the next 5 years.
Sure, I understand that. Let me be more specific with regard to edible oil. So it's been a bit of a drag, and I think it's a problem with the entire marketplace as a whole. It's not just a Patanjali problem. But when you're seeing some bit of stability now is what you suggested even in December, you continue to suggest. When do you start seeing a recovery? When do you start seeing an outperformance in terms of that business starting to really pull its weight with regard to its numbers to contribute to yours?
So it's already pulled up. In fact, you will see that when we declared the results, the edible oil in quarter 3 has improved substantially. And quarter 4 should be, pretty much at par with quarter 3. And I'm expecting that the market to have stabilized. So we've always projected that, the edible oil business should throw up EBITDA margins of between 2 and 4%. I think that we are pretty much on course for that. And there's an increasing confidence that, with the distribution sort of expansion, with the brand premium that we are making efforts towards, superior risk management and the international market being supportive, I think we should be pretty much on course on the edible oil side to stabilize, the margins.
I understand. And, as you grow some of your other product portfolios, when it comes to biscuits, nutraceuticals, as well as your other food segment, how do you see your revenue mix evolving in terms of products?
So currently, what we have is that we're close to 30% of the revenues are coming from the FMCG. The target is very clear that over a period of time, we would like to take it to 50-50 between the edible oils and FMCG business. And we are pretty much on course. So, 2 forms of growth we're looking at. One is that 15 to 18% growth in revenues on the FMCG side, driven by both the organic growth as well as launch of sort of newer products, product ranges and categories that we are working on. Likewise, on the edible oil side, our growth expectation is between 2 and 4% on the revenue terms and pretty much consistent with the growth in the marketplace. And so the strategy is very clear. In the edible oil, we'd like to stabilize the margin and grow. In the FMCG segment, we'd like to retain the margin construct and expand, the share of revenue in the overall company's basket. So target is very clear that, 50% of the revenue should come from the FMCG. The balance part should come from the edible oil. And at the margin profile-wise, we should move towards a double-digit EBITDA over the next 5 years.
Right. And apologies if I missed that. So the 50-50 split with regard to revenue mix, how quickly will you achieve that? Would that also be a 5-year target?
No, I think we should be doing sooner than that. I think it's already a year has already passed. And, what used to be 18%, we are closer to 28% now. So there's an increasing confidence that we should be able to sort of be there probably closer to 4 years' time. And it's a simple maths. In FMCG, we are growing at 15 to 18% year on year, and the edible oils, we're growing at 2 to 4%. I think we should be able to catch up, pretty much with that number in 4 years' time.
Understood. One piece which you have a really good year on the ground to is with regard to rural recovery. How is that playing out? Because you're still seeing some signs of sluggishness, and that doesn't seem to have gone away at all. We are into Q4. When do you see that kind of somewhere recover?
No, it's one of the parts which has impacted the entire FMCG segment. So right into Q3, the rural demand with some sort of green shoots of recovery that we saw, it's a little still slow to pick up. My expectation is that the monsoons have been good. I think especially the winters are very intense. So hopefully our the grain harvest and the crops in the Kharif harvest that we're going to see now. I think the sowing that has happened in Kharif and the Rabi harvest that we'll see, I think should be pointers to better recovery. The agriculture prices, have also had a slightly bullish bias recently, other than edible oil. So right from pulses to spices to grains across the board, and I think that should put more money into the rural hands. So hopefully we'll see some recovery, but it has been a source of concern because last several quarters the demand has been a little on the slow side.
Right. You had 2,000 odd crore of cash. You continue to hold a good quantum of cash. You also, as you correctly pointed out, have good capability with regard to cash generation going forward. Capex seems to be limited, at least basis announcements. What are you going to do with some of the money that you've picked up and sitting on your balance sheet?
So right now we haven't had an occasion to yet. We have not seen any good target for acquisition and put the money to effective use. But we explore that constantly. So right now, while the acquisition is not on the cards at all, but I think the deployment is in terms of investing behind sort of using our internal cash accruals to brand building, in the advertising and marketing, putting some bit of effort towards the technology side, new product launches. So I think right now we'll continue to my expectation is that the free cash flows should support larger cash in the balance sheet. And over a period of time, we should be in a situation, if tomorrow, both either internal or external, there's an opportunity, then we will not shy away from sort of pursuing that.
Sure. So probably an acquisition on the cards. Is that something that you're open to or you're actively looking for?
No, we're not actively looking for it all. And there's nothing on the cards right now. It's just that there's a lot of sort of structures and internal restructuring which has happened in the past 18 months. There's always a possibility, but there's nothing on the cards that we need to we started working on. We'll wait for that to occur as and when that does. In the interim, the effort is pretty much what I outlined for you, that basic 101 of running a good business. That's what our effort is towards.
Right. I'm going to try and squeeze in one last question. Try and help us understand, there's a consolidation which is going on in the industry. We saw quite a few acquisitions by Tata Consumer, more premiumization. If you can give us a quick reflection of how Patanjali thinks of this in maybe 30 odd seconds.
No, I think it's very essential. So clearly being just a value-based player will not be sufficient. So we've been working on premiumization. We'll continue to work in expanding our portfolio and straddle the spectrum of both the value player as well as the premium player. And we'd like to grow our premium portfolio. And that's the work which is actively the company is pursuing as well right now.
Sure. It's a pleasure speaking with you, Mr. Asthana, and it's good having this kind of perspective from Patanjali. We'll, of course, keep chatting with you on and off to try and be updated with regard to how Patanjali is evolving as a company, as a business. But lots happening with regard to how the business is playing out. But it's time to slip into a very short break. Stay tuned. We have the management of HCL Tech joining on the other side. That stock is up and about in trade today. And of course, on the back of very strong numbers. So do stay tuned. You're watching the Small and Mid Cap Show on ET Now.
Hello and welcome to NDTV Profit. Joining us today is Mr. Prateek Agrawal. He's the Chief Financial Officer of SCL Technologies, and Mr. Ramchandra Sundararajan. He's the Chief People Officer at SCL Technologies. The gentlemen are speaking to us after the company's third quarter earnings, where the revenue rose about 6% in constant currency terms sequentially, while the EBIT was up 14.7% to about 5,600 crores. EBIT margins, or the operational profitability, was sustained at nearly 20%. Gentlemen, first of all, welcome to NDTV Profit.
Thank you.
My first question is to Mr. Agrawal. Just wanted to ask first, it's surprising that you have narrowed your guidance for FY24 after such brilliant earnings. So what is the rationale behind the revision in guidance to a narrower band?
So first of all, I would like to wish NDTV and all your viewers also a very happy new year. And along with the new year comes the harvest festivals. So happy Lodi, happy Pongal, happy Makar Sankranti, and all the harvest festivals in different states. Coming to the numbers and to your question, as they say in cricket, you cannot hit a sixer in every ball. So this quarter was certainly a sixer of a quarter, but we don't think we'll be able to hit another six in the immediately next quarter. So we have kind of tempered down the higher end of the range. Instead of 5 to 6%, we toned it down to 5 to 5.5%. I think what is to be kept in mind is 5 to 5.5% is better growth, much better growth than all of our large cap IT peers. And secondly, even to deliver this 5 to 5.5 range, our services business has to deliver 1.6% to 3.5% sequential growth, which is what we are penciling in. And we expect to be in the higher end of that range for the services business as well.
So, Mr. Agrawal, why do you think that the January-March quarter will not be as good as the October-December period? Can you give us some guidance on it, as so to speak?
Very simple. It's the seasonality of the products business, the software business. December quarter tends to be a peak. It has been a peak in any of the last 3, 4, 5 years, if you look at it. And March quarter, the seasonality in the software business is not going to be there. It's going to be software is going to decline as it typically does in the March quarter compared to December. So that's the simple reason for that.
Okay, but you are confident about maintaining your operational profitability at 18 to 19%. So what are the margin levers still in play for you for that confidence, sir?
I think our run rate in the last 2 quarters has already built a solid foundation. So we were at 18.5% in the last quarter, and with the software seasonality, this quarter is 19.8%. So we are on a good trajectory, and we hope to continue our good run. So we are pretty much near the middle of the range so far in the 3 quarters. And with the 4th quarter, we don't expect anything different.
Okay. Mr. Sundararajan, welcome to NDTV Profit. First question, again, you are an outlier in the hiring space as well. So you are the only company of the top 4 who have declared the earnings so far to add to your headcount, while attrition, I think, correct me if I'm wrong, attrition has moderated to pre-pandemic levels. So how have you become an outlier again in this quarter, adding to the headcount when others are actually getting their, have their headcounts declining?
So I think if you look at the hiring, it's a reflection of the growth that we have delivered in the quarter. We have delivered significant growth in the December quarter. So our hiring reflects the growth that we have delivered. There are 2 contributing factors for the net headcount increase. Even our own business, if you look at in the previous 2 quarters, we had a negative headcount growth. This quarter, factor 1 is we continue to onboard freshers that we had made offers to. So that's about 3,800 plus offer people that we onboarded this quarter as freshers. And we also had to ramp up for the mega deal that we had signed in the previous quarter, which went live in beginning of November this quarter. So those are two significant factors that contributed to our net headcount growth this quarter. And we expect that trend to continue into Q4 as well as we look ahead into Q4, where we are looking at services business growth. We'll have both Q4 freshers onboarded as well as lateral hiring continue into Q4. So we expect the net headcount increase to happen in Q4 as well.
Okay, Mr. Sundararajan mentioned about the deal ramp-ups. Mr. Agrawal, talk us through how your Verizon deal as well as the ASAP Inc. deal are shaping up. Especially give us some color on how the ramp-up is happening. And secondly, a second part of the question, is discretionary spending coming back? What is the sense that you're getting from your client conversations?
So, yeah, I would not spend too much time talking about any particular client or the deal from that client. But suffice to say that it is a well-planned series of actions across the globe. So as you can imagine, rebadging is the fastest in the US, takes a little bit of time in Europe, etc. And then there is work that we are starting to take over from some of the other vendors as well. So all that is going pretty much according to plan, just like the deal started off on November 1st, as we had announced. So everything is going as per plan is where I will leave it. On the discretionary side, I think we are beginning to see some green shoots in the ER&D business. ER&D, even outside of ASAP, saw a 2.5% growth organically in this quarter sequentially. And even last quarter, we had 1.6% growth organically in that business. So while we are seeing some green shoots there, in the IT and business services, which is the largest segment, there we are still sort of waiting for some good news on the discretionary front.
Okay. My final question is to you, Mr. Sundararajan, is about the impact of AI. So how are you in the workspace for your employees leveraging AI to shore up your utilization levels? You are adding more employees. I'm sure you are putting in AI as well. So how is that fitting into your scheme of things, sir?
So AI, at this point in time, it's all in pilot phase and proof of concepts is what currently is. And as you rightly said, both in terms of work that we do for our clients as well as the work that we do internally, number of areas. We do have a number of use cases currently going on so far as AI is concerned. Right now, this focus with reference to AI is all about upskilling and getting ready to be able to take advantage of the opportunities that will come a few quarters down the line. So over the last few quarters, we have so far upskilled and certified 40 to 50,000 employees of ours in use of AI. And as I said, right now it's all about pilots, POCs, use cases, both internally as well as for the client work that we do. That's currently our focus. And as we scale that, we also expect that we will be doing targeted hiring into our Gen AI and data practice, where we will look for niche skills to be added to the training efforts that we are putting in. So that's going to be our plan as we go forward into the subsequent quarters.